Welcome, you are Aussie. Rosessa now is the principal for Far East Capital. Now, you're in for a treat because I've known Warwick for a number of years, and what he does not know about resources isn't worth knowing. And we've over the years, he's invested, he's understood the numbers, and he really understands what's going on. Good markets, bad markets, he's seen them all. Warwick, great to see you, even if it's on Zoom.
Yes, thanks, Kerry.
Well, let's start off with the sector as it stands today. You know, back in May and June, we had a little bit of a blip. So do you want to talk about the size of the resources sector, but also, I guess, what's the appetite like at the moment for the resources sector?
The appetite's surprisingly strong if you look back through history. We still are in a period of strong demand, a lot of money flowing around. There's money being made. Sure, we've had a bit of a sell down, but that was an automatic response to rising interest rates, a bit of fear and a bit of panic. But the way it bounced back from its low in June suggests that it's got a lot more depth and a lot more life in it than any time I've seen in the past when we've had these sort of sell downs. You compare it to, one question that you asked me yesterday, should we be expecting a crash at any time? Well, the real crash was in 87, and that ushered in a period of misery for a long time. But the falls then, in total, were really no worse than what we had in April, May, June this year. It just happened a lot faster this year, and it recovered a lot faster. And I think that's what we should be expecting of markets. You can lose money, but that's if you have to sell in a short period of time. So I think to comparing the sector today to what it might have been 10, 20 or 30 years ago, there's a lot more money tied up in the Australian exploration and junior sector. Total market capitalizations are much greater, number of companies. There's a lot more players which give it a lot more depth. When you have everyone doing the same thing at the same time, that's where you get the extreme volatility and the falls we had a few months ago. But then if they decide, well, maybe it's oversold, look how quickly it bounced back. So, I think there are big differences to the way the market used to be. In terms of capital availability, that's a good indicator. Look how many people raised money after the collapse down to June and how the players came back in. The velocity of money is the big telling factor here. Mm-hmm. Day trading is very active. You might see enormous turnover in any particular company on a good news announcement. But what we don't really know is how many minutes people have held those shares for. Are they?
Did you say how many minutes?
Yeah. Because you might say, well, there's been 50 million shares traded in this company. That's, that's 10% or 20% of the capital, but it's the same stock turning over and over again. So it's very hard to analyze properly. The other thing about the markets today is the depth of commodity coverage. In times gone by, it's been all one particular sector. It might be the gold sector, or one particular commodity might be going for a run. But now you've got new age metals, and they're the ones that the greatest level of uncertainty exists around. They're the ones that are most difficult to analyze on a fundamental basis. But then ask yourself, well, what's the point of doing fundamental analysis and working out earnings per share when it just gets washed away with the volume and the velocity and the emotions of trading today? So it's much less fundamentally driven markets, and the performance now is based more on promotion rather than technical performance or excellence. And there's very little real analysis that goes on. Most of the analysis is done for corporate reasons. There's a lack of fundamental research. We're probably at the lowest point we've been in for 40 years for people actually doing spreadsheets and working out what a company is worth. But, a company spreadsheet, from my experience, you can fool yourself into believing your own work, rubbish in, rubbish out. It's much harder for analysts to get good information now. I'm very lucky that, having been around for 40 or 50 years, a lot of people know me, so they'll take my call. But if you're a new analyst starting out, directors, CEOs, they have so much caution about what they can say to investors. They don't know whether they're allowed to say this or that, say that, so they don't talk to anyone.
So they say nothing.
Yeah, they say nothing. And then they just rely on hyperbole in stock exchange announcements that as a communication tool. So we're seeing a proliferation of lightweight online promotion. Companies, there's quite a few of them around. They use the internet to put out verbose emails saying how wonderful this company is, and it might go for pages and pages. But if you look at it, they're not really telling you anything. They're just promoting, and that's what drives stock prices. There's a lot of people, a lot of smaller players in the market today that have no access to any sort of true fundamental research. They're relying on FOMO to make money. If these newsletters are coming out saying you've got to have this because of this and that, well, they think, well, this could move the price, and so they buy on the basis of that. But they've got no idea what they're buying, really.
No, it's not a good way to create a market, though, is it, Warwick? Because I mean, if you're not looking at the true worth of a company and you're just going on, as you said a moment ago, FOMO, it's not. And is that mainly the resources sector that this occurs in, or are you saying that this is the new reality in markets these days?
It's more in the resources sector because there's a lack of certainty. There's less precise numbers. In an industrial company, you can analyze that more. There's more information put out. It's driven by more macroeconomic issues, interest rates and things like that. But for 99% of the mining and exploration sector, they're never going to make money. It's all about providing gambling chips and vehicles for people to play in a casino, and that's what the stock market is.
That's a big ouch there, Warwick.
Well,
so why do we bother? Should we? I mean, you just said 99% of them are going to go nowhere, but that belies the fact that just before you talked about new age metals. Quite frankly, we're going to need a lot more copper and a lot more lithium, a lot more nickel, a lot more coke, et cetera, et cetera, et cetera. So is it really gambling? Because the supply demand is, well, the demand is definitely there and the supply is not.
Well, there's a lot of speculators in the commodities and the stock market. And, you've got a compound effect. I saw some figures earlier on this year where the price of wheat and grains out of Ukraine doubled in the space of 2 weeks because the speculators got in. But now, 6 months later, they're back to where they were before. So there's still too much money in the system to make people prudent with it. It's just a big gambling casino. I say it's sophisticated gambling, and as each decade goes past, it becomes more so. And I don't think it's going to change unless we have some disaster which washes all the money out of the system. And I can't see that happening in the short term. But the other thing is, the market's being driven on exceptions rather than reality. How often do you see a company say exceptional drill results? Well, I look at that. I say, well, if it's an exception, we're not going to get any more of it. So what are you harping on about? So that you see stock exchange releases that concentrate on the highlights. You've got 5 highlights, and that captures your imagination. How many people read past that? You'll see a company that announces one big intersection and talk about that as great, but the other 19 are crap. But they don't talk about that. What we're also suffering, like I said before, with CEOs. They're not allowed to talk. They're not sure what they can talk about. You've got continuous disclosure, which is actually suppressing information now. To start with, the stock exchange was insisting that companies come out and say things, but now they're being overworked, and they're saying, well, we don't think you should be saying that now. they're interfering, and that gets me to the point about on my little list of things, an anal and capricious interference by the stock exchange in what companies say.
That's very intense, anal and capricious interference. What do you mean by that?
Well, the stock exchange likes to regulate what you're saying.
Yep.
And they'll pick on companies because they don't like the companies or the people. They're very inconsistent. The capriciousness comes about because whether or not you get treated fairly by the exchange depends on whether you get on with your advisor or the person that you have to deal with. You know, for one example, there's one example of a company that the stock exchange wouldn't allow them to make announcements on many things that shareholders would have loved to have heard about, but they say, well, the stock exchange is not the appropriate forum on which to put out this information. So this was going on for many, many months. That particular person has gone on maternity leave. The person who's now handling the account is giving them a much better run for their money.
Wow.
And so you've got inconsistency.
Mm.
It's a real problem. The more companies we get, the problem's getting worse because the stock exchange cannot act within the time frame required to do the supervision they want. Quite often you've got the stock exchange coming back a few days later. What do you mean about this? You know, put out an explanation on it. You know, it's not good. The problem with the stock exchange is they don't understand what they're regulating. They don't understand markets. It's populated by either lawyers or public servant mentality people who don't understand the dynamics of the market. They don't understand the purpose of it. Really, we all know that you can lose money in the stock market. Very easy to lose it. So why does the stock exchange go out of its way to try and make it so it's harder to lose money? You know, we get attracted to it because we know we can make good money, but we don't want the interference of public servant organisations like ASIC or ASX trying to regulate it when they don't have the staff numbers, they don't have the intelligence or the training. So the more they try and regulate it, the more companies find ways to get around it. One way to get around a lot of the rules now is we see so many companies making quotes. So it's not actually the company making a release, it's the directors or the CEO coming up with rambunctious hyperbole in their quotes and say, well, that's my opinion, that's not a fact. And they get away that way. So, you know, that actually just throws fuel on the fire of already a pretty wild stock.
So if Warwick Grigor had his way, what would he do to make the system work better? Just have a big red flashing light saying, warning, warning, very high risk, you'll probably lose all your money, but go for it anyway, and keep it simple, stupid.
No, I wouldn't go that far. What I try and do in my research and my commentary is just educate people.
Yeah,
make them a bit smarter. I think some of the hyperbole used in the announcements, like, you know, fantastic drill results and you know, that sort of wording should be frowned upon. It should be a bit more objective. The numbers should be able to speak for themselves. So there's an overprint of basically over promotion, which the market needs to step back from. There needs to be responsibility with the companies themselves. If the companies are not responsible, that opens the door to the regulators to get involved and use its type of supervision, which doesn't work.
Right, got it.
But
well, look, Warwick, I want to make sure that we touch on some of the points we discussed prior to this chat. A lot of people at the moment are looking at the market. It's very volatile. It's up one day, it's down the next. There's concern. They're not quite sure. So where, in your opinion, does the risk currently lie in the markets right now as we speak to you?
Well, you've got market risk and company specific risk. I think the market risk comes about as an accumulation of everything else thrown in. But company specific risk, I think, comes about from misreporting, very selective reporting. And you've got to be very careful of that. You know, examples of that, there's a company called Oramin that made a release on the 5th of September. It announced 352 meters and 1.5 grams in an intersection. Normally you'd look at that, this is out near Sandstone, you'd say, oh, that's fantastic. But then you have a look and you see it's drill down dip. Now, it's not the first time this company's done that. The true width of that, the mining width of that intersection might be 20, 25 meters. I think it's very misleading to report it a down dip hole without explaining why it's down dip.
For those that don't understand, when you say down dip, what do you mean?
Drilling down the guts of the ore body, which gives a false impression. It makes it look like intersections much bigger. When you look at a drill hole, you need to convert it to true width, because that's the level as you go down and you mine the ore body. It might be 20 meters down. But if you've got an ore body that goes like this, and you drill right down the guts of it, it's going to be very misleading. So companies have got to avoid doing things like that. Another interesting release I saw, company announced 18 meters at 4.2% copper, including 5 meters at 7.1% copper. Now, normally you look at that and think, well, that's fantastic.
Yeah.
That's one hole out of 17. The rest of them were very, very ordinary.
Mm.
In fact, the JORC resource on this property is about 8 million tonnes of 0.84% copper. Now, how do you correlate one intersection at 7% with a JORC resource of 0.84%?
Mm.
So you've got to look at things like that and make sense of it. So I think companies need to lift their standards. Quite often, I'll say, well, hang on, their rhetoric doesn't match the results. There's too much, basically, bull dust. There's too much rhetoric, which is actually designed to give the best possible perspective, which is not the realistic perspective. So deciphering the truth of what the companies make is the big challenge. And you just can't trust the companies to be truthful in most cases.
And by the way, Warwick, while you're speaking, sorry to interrupt you, ladies and gentlemen, if you'd like to ask Warwick a question, we've only got about another 5 or 6 minutes to go. But if you want to pick his brain while he's on screen, pop your question in the Q&A, and I promise I'll get to it and ask Warwick your question. So make sure you become active and ask some questions. Sorry, Warwick, go ahead.
That's all right. Another example, which I have to mention, a company announced, Tennant Minerals announced on the 7th of September, massive sulfides grading up to 54% copper. Well, normally you'd wet yourself on that, but if you read it more closely, it's based on less than 1 centimetre of the core. Now,
Wow.
That's incredibly misleading.
So how do they get away with things like that, yet other companies are really pushed to say, like, they're constantly being told, you know, you can't say this, no, you can't say that. Is that the inconsistency that you're saying with the regulator, that some things get let through the gates and other things, they don't even get close to the gate?
Yeah, because the stock exchange doesn't have employees they don't have the manpower and they don't have the experience to point out things like this. So that's what experienced analysts like myself can do, but we've only got a limited reach. I do what I can, but you know,
you are very good at it. And by the way, I said people could ask questions, and now they're all flooding in. I'm not sure whether you can answer this. Mike's just asking if you got a view on FGR at the present.
That's a company specific. I'm the chairman. I don't think it's appropriate that I answer that in this forum.
Thank you very much.
He can contact me directly if he wants, but not in this forum.
Right, Mike, contact Warwick directly, and he'll try and answer that question. Jason, the wonderful Jason, is asking, how do we increase quality regarding an earlier comment? There's no way the quality of reporting will increase with fewer and fewer quality people running companies and more companies, more than 880 now, which is the ASX model. They make money from more listings, and enrollments in STEM universities are down 30%. So what he's saying is that the ASX is making money from more listings, and then enrollments in the universities are down by 30%.
So what do we do about it? It comes down to the grassroots.
There's a mismatch.
Sorry, Kerry, that just dropped out a bit there.
That's right, I can still hear.
Yeah, look, there's no easy answer. How do you make people honest? You can't legislate to make people honest, because the honest people just find life more difficult. The crooks were never going to obey the laws anyway, so why should they obey the new laws? I think, you know, a better educated investment community is a good start. But we all know the stocks that run the hardest are the ones they tell the biggest lies about. So if you just want to make money in the market, maybe you follow the thieves and the crooks, but you enter that gambling arena, but you have to be smarter than the next person and know when to sell. So I think there's no easy solution around it. Quite often as an analyst, you know, you need to be bipolar. You need to see the reality for what it is, but then isn't the stock market and the share price movements the real reality if all you want to do is make money? So, you know, I'll not go into some things out of disgust for what the company's saying and all the dishonesty, but that could be costing me money.
Yeah, probably. Andre, the lovely Andre, is asking if you can, you know, you've given some examples of company results and what they've said and how they're slightly misleading. Andre's just asking if you can give some more positive ones that you're looking at. So in other words, more recent positive results that perhaps he should look at. But I think, Andre, in this forum, it's probably best if you have a look at Warwick's research reports that he puts out on a weekly basis to answer that question. What do you think, Warwick?
Yeah.
Or you've got something close to hand.
Well, there are obviously some good companies out there, and they're the ones I prefer to deal with. I will write up good companies, I'll write up bad companies. I get opinions across. Now, as Kerry just said, I do a weekly that goes out on Saturdays. I don't charge for it. It's part of my mentoring activities in the markets. If you go to the Far East Capital website, you can sign up for it, and it goes out most Saturdays at no cost. My interest is to try and have a better informed investment community,
Which I think is fantastic. So make sure you go to, is it fareastcapital.com?
AU.
fareastcapital.com.au, and it's really good. And I love the fact that you're trying to educate people, because at the end of the market that then loses their savings is not a good market that either any of us want to be involved in, is it?
No.
Final comments to you, Warwick, before we wrap it up.
Good luck. You can make,
all right.
If you get it right, you can make a lot of money, but you have to be disciplined. You have to know when to sell. And I find one of the best ways to see all through the smoke is be contrarian.
Any particular sector that you like right now, speaking of being contrarian?
Oh, that always puts me on the spot, doesn't it?
I love putting you on the spot.
I prefer individual companies within sectors. I don't think it's a sectorial approach. I think that there is some great value for stocks that don't look exciting, and it's easy to get stories that are overlooked. Just keep turning over those stones and you'll find the gems, and don't be scared to buy when no one else is.
I love that. Be a contrarian, buy when others are not looking. That's when the opportunities can absolutely be there. Do not buy when the taxi driver, nothing against taxi drivers, turns around and says, I've heard of a hot stock that you should buy. Warwick Grigor, Principal for Far East Capital, thanks so much for joining us at the NWR Aussie Resources Conference. Great to see you.
Pleasure to be of help. Thanks, Kerry.